Adam Wolfe, thank you so much for joining me today. So, we're going to talk about emerging markets in general and specific. I was looking at a presentation that you were making where you talked about how emerging markets saw a sustained growth phase between 1998 and 2016, and then it's turned. Now, what are the broad factors that have been driving emerging market growth, which is flow of capital into emerging markets from developed countries, and what's done and why is that happening?
I think the big turning point has been, or the big structural factor holding back our emerging markets over the past 10 years or so has been the dollar. The dollar's been appreciating against a broad basket of other currencies. And typically what you see is when the dollar appreciates like it has over the past 10 years, that leads to bad events in emerging markets. And this time around, it's really just led to kind of doldrums growth in emerging markets, where the growth differential between emerging markets, excluding China, because it's kind of a separate thing now, and developed markets narrowed from about 3-4 percentage points down to, well, just about nothing really in 2020. But even that kind of outcome is better than what we would expect in previous dollar cycles. If you think back to the early 1980s or the mid 1990s into the early 2000s, you saw a number of emerging market financial and debt crisis at the end of those dollar cycles. And this time around, we saw a few of those, but just in kind of smaller frontier markets. And most emerging markets actually have managed that appreciation of the dollar much better, but still had these headwinds for economic growth that comes from that.
And what explains, for someone who's trying to understand, what explains this sustained rise in the dollar itself?
So I think typically what's driven that in the past, which is a little bit different this cycle, is that you've seen aggressive monetary tightening in the US, and that's sucked capital out of the rest of the world back into the US. This time around was a little bit different in the sense that a lot of it was coming from just very strong earnings growth in the equity market from a very small portion of that market. And also somewhat less aggressive monetary easing relative to other developed markets. So the U.S. treasuries were still attractive for investors in Europe and Japan, for example, and that pulled money into the U.S. and leading to the appreciation of the dollar.
And, so when we look at emerging market flows from the West, now it's not only the United States. While the dollar is the defining currency, but it's also coming from other countries, including in Europe. So, but you're saying that really it's the dollar which is determining where money will go, not from where it's coming.
Right. I think because the international financial system, by and large, is a dollar-based system. And so no matter where you sit, it's kind of dollar funding costs that determine the overall kind of funding flows for the rest of the global economy. And so where the dollar goes, by and large, the rest of the world kind of moves in that direction as well.
And so if let's say big funds, including endowments and long-term pension funds, they're the kind who also invest in large amounts for long periods of time in emerging markets or have invested. If they've not been investing so much in emerging markets in this period, particularly, let's say, after 2016, so where have they been putting their money?
A lot of the money has gone to the U.S. You can see the flows into U.S. treasuries, which is really just an alternative compared to, they've looked more attractive to European bonds that they might have added to those portfolios. But a lot of that has gone into the U.S. equity market, and you can kind of see the concentration of that into the U.S., and you see the outperformance in terms of valuations as well. And that's been driven partly by earnings growth, but that earnings growth has attracted those flows and bid up the price of those stocks.
And where would you see, say we are in the cycle today? Are we sort of plateauing? Is it still going downwards? I'm talking about the flows, because the dollar, of course, has weakened, and I'll come to that in a moment.
Yeah. So in terms of the flows, it doesn't look like anything has changed dramatically so far. So we saw this blip in April when the first round of tariffs came from the U.S., and you saw U.S. Treasury yields spiking while the dollar was depreciating, and that kind of led to some outflows. But that's since reversed, and you're still seeing flows going back into the U.S. I think the difference since April has been a larger portion of those flows have been hedged now, or currency hedged. And that's kind of led to this decoupling between treasury yields in the dollar that you typically don't see.
Hmm. And I mean, if I were to now come back, I mean, what's the outlook here on? I mean, if we were to look now, uh, it's been more than 6 months of tariff tantrums. The uncertainty seems to have been absorbed by or most markets, though the economic damage, I suspect, will be felt much later or for longer. So, which way could flows go?
I think that we're probably nearing a tipping point in terms of flows and for the dollar itself too. That if you, I think a simple way to put it would be that the global investors are over-indexed to the U.S. at this point. There are new questions emerging about the safety of those investments for political reasons, but also for reasons of just market concentration. That really it's six stocks driving most of the U.S. market at this point. And the dollar is really overvalued by almost any metric right now. And currencies do tend to mean revert over time back to their fair value. And so you have that kind of valuation and the catalyst to push it in that direction. So I think we're probably nearing this tipping point where we should be in more of a structural bear phase for the dollar. And that bear phase will mean net outflows from the US to the rest of the world.
Hmm. And what's your sense about emerging market risk appetite right now? So again, if we were to keep dollar aside for a moment, I know you can't do that, but if you were to for a moment, I mean, investors spend time and effort trying to understand, identify stocks in emerging markets because they saw long-term growth potential, higher alpha, and so on. While that may be sort of being counterbalanced by the strong dollar all this while. Uh, I would imagine that there is still risk appetite, or well, let me put the question this way: what's your sense of that risk appetite when it comes to emerging market equities?
So we haven't seen big flows into emerging market equities so far. And I think that global risk sentiment towards emerging markets is still somewhat cautious. I think that the economics look relatively positive or have looked relatively positive so far. So you see that real GDP growth differential widening back out between emerging markets and developed markets, which is really the thesis of investing in emerging markets is that they should grow faster than developed markets. And so that thesis is being reflected in real data again. So that should be pushing flows in. I think that the volatility in U.S. politics and what that's meant for the global economy has left people a bit more cautious. And so while there are concerns about the riskiness of U.S. assets, that's not going into even riskier assets. It's going into close alternatives for other safe assets. So gold has done very well as a result of that because it's in terms of the risk spectrum, it's closer towards the treasury than a EM bond would be necessarily.
And if you were to look at, let's say, the rest of 2025, how are you seeing the overall behavior of the dollar versus flows once again?
I think as things start to settle down and economic fundamentals become more important, that we should start to see more flows going into emerging markets and going in further out on the risk spectrum in non-US assets. And emerging markets will benefit from that as well. I think Europe also looks attractive since some of the flows will go into Europe and EMs might not absorb the bulk of those flows. It might be a smaller portion, but it'll be a net positive compared to what emerging markets have seen over the previous 10 years.
And I mean, I don't know if you've done any sort of early studies on what the impact of tariffs are going to be. But what's your sense? I mean, not so much linked to investing in equities, but what's your sense in terms of the economic harm, or if so?
Yeah, so I think for most emerging markets, this is an absorbable hit, that it's half a percentage point off of GDP growth or something like that. And for a country like India that's growing 7.5%, that probably doesn't even get noticed. For some other countries, the hit might be a bit larger. For smaller, more open economies, the hit will be larger. But in the aggregate, it's going to knock a little bit off of GDP growth, but not really disrupt that growth pattern over the medium term. And I think that there are some offsetting benefits for emerging markets. One would be the dollar itself. If it were to depreciate, because most global trade is invoiced in dollars, that means that imports become cheaper for the rest of the world in local currency terms, and that tends to boost the volume of global trade overall, and that can offset some of the impact of the higher tariffs in the U.S. which will drag down, about 15% of global imports come from the US. That is a meaningful headwind. But if the other 85% is growing faster, that absorbs some of that impact.
And what's your sense on, now all the other major countries, China, Russia, India, for example, have just got together. There's an attempt to present a unified front of sorts against the United States in the tariff context. What could this lead to? It could lead to not much, but if it could lead to something, what could it be? As a macroeconomist.
Yeah, there are a number of outcomes that this can lead to. So I think on the most extreme would be a real economic and financial and closer financial integration between the economies and moving away from this international dollar payment system, trying to settle more trade in local currency, for example. Or the easiest thing would be to settle more trade in Chinese renminbi because the international payment system exists already as an alternative to the international dollar payment system. And so we can see more of that trend. And you are seeing Chinese banks lending more aggressively abroad in renminbi rather than dollars they have done traditionally. And that can kind of push a portion of emerging market activity into a different system that would have behaved differently from this kind of global dollar cycle that we've been talking about. I do think that South-South trade has been a growing portion of most emerging markets' export baskets. And so the BRICS broadly defined trade more with other BRIC countries than they do with the US and US allies, and kind of NATO broadly defined, plus Japan and Australia. And that trend will continue, and that also makes them a bit more insulated from kind of the cycles in developed markets. I think what's difficult is that South-South trade can't be a direct replacement necessarily for U.S. imports, because the products that India exports to the U.S., for example, only about a third of that export basket overlaps with the export basket of what it exports to the other emerging markets. And so it's just it would require a more aggressive retooling of the economies that seems unlikely in the short run. But it's a helpful offset, but it's not a direct kind of one-for-one replacement.
Last question. So, when you get up in the morning, what's the metric that you usually look at to see where the world's at from your vantage point?
Well, I think that the two most important variables for financial markets are really the dollar, the trade-weighted dollar, and where the U.S. 10-year Treasury yield is. And that helps to determine where everything else is going to flow. Because I do think that the dollar cycle really is the dominant financial cycle for the global economy.
Right, Adam, pleasure speaking with you. Thank you so much.
Thank you for having me.